Now, imagine you are running a business and you have just made a deal with a customer, but instead of just one deal, you end up making two or more deals around the same time with that customer. So, same customer, same time, but more than one deal. IFRS 15 here has a specific rules for situations like this. It's like when you go to a phone store to buy a new smartphone and end up getting a deal that includes a phone case and a pair of headphones at a special combined price, for example. IFRS 15 here introduces the principle that under certain circumstances, an entity should combine two or more contracts with the same customer into a single contract for revenue recognition purposes. This approach is taken when one of the following scenarios or situations exist. The first situation where the contracts are negotiated as a package with a single commercial objective. So if you and your customer blend these deals together as part of a package deal with one main goal in mind, IFRS 15 says to consider this as one contract. It's like buying a combo meal at a restaurant because you get a better value for money than ordering each item separately. The second situation that you can combine contract together when the amount of the consideration to be paid in one contract depends on the price or the performance of the other contract. Sometimes how much you pay for one deal might depend on the detail of the other deal. For example, the price you pay for the phone case might depend on whether you buy the smartphone. If that's the case, so IFRS 15 tells us to view these deals together as one. The third situation that you might combine contract together if the goods or services promised in the contract are a single performance obligations. In this case, if all of the deals together add up at one big job or goal, then according to IFRS 15, you should combine them. Going back to our smartphone example, the phone, the case, and the headphones together provide you with a complete mobile package, correct? If your deals are like this, where everything is meant to work together to meet the customer needs, then they are treated as one contract. As you see on the screen, this visual summarizes everything we explained on combining the contracts. So let's explain it again and let's summarize this visual. We will start from the first question, asking, are the contracts entered into or near the same time with the same customer or related parties of the customer? So if the answer for this is no, so we have to account for each contract separately. But if the answer is yes, so go to ask the second question. Are one of the following criteria met? So we presented three situations that we can combine contracts in one of them. So for example, the first situation was contracts were negotiated as a single commercial package, or consideration in one contract depend on the consideration of the other contract, or the goods or services, or some of the goods or services are a single performance obligations. So if at one of these situations exist, so in this case, we have to account for the group of contracts as a combined contract as a single contract. So in this case, we will not deal with every contract separately, but we have to combine them. But if none of these situations exist, so in this case, we are going to account for each contract separately. Let's take an example. Consider a software company called Tech Innovate, which enters into two contracts with a customer. The first contract is for the development of a custom software, and the second contract, signed simultaneously at the same time, is for ongoing maintenance and support of that software. Both contracts are negotiated with a single commercial objective in mind, which is to provide the customer with a fully functioning custom software solution. So, according to IFRS 15, because these contracts are negotiated as a package with a single commercial objective, the company should combine these contracts and treat them as a single contract for revenue recognition purposes. So, what will be the journal entry upon contract combination? When combining contracts, no immediate journal entry is required for the combination of contracts. However, the entity would assess the combined contracts in order to determine the transaction price and allocate it to the identified performance obligations. Let's take another example. Imagine a construction company which is called Buildrite. This company signs a contract with a customer to construct a building. Shortly after, a second contract is signed to provide landscaping services around the building once it's constructed. The pricing of the landscaping services is significantly discounted based on the assumption that the company will also construct the building. Now, let's analyze this situation. Given that the price of the second contract depends on the performance of the first contract, and the contract were negotiated closely together with a single objective to complete the building project fully, IFRS 15 here would guide the company to combine these contracts. Upon combining contracts, and similar to the previous example, the focus initially is on the accounting treatment to recognize revenue appropriately over time as the performance obligations are satisfied rather than an immediate journal entry related to the combination of contracts. So, why does this matter? When you are running a business, how you record your deals in the financial books can affect your business look to the investor, banks, and even to yourself when making decisions. IFRS 15 here helps make sure that the way that you recognize revenue from your deals reflect the real economic situation, making everything clearer and more straightforward.